Hey there, guys. Welcome to the Insider Stock Pick for this week. I'm excited to dive in with you. Just waiting to see if anybody popped on, but I'll go ahead and get started just for the replay and make it a little bit more enjoyable. So the stock this week is actually I don't know if you had a chance to look over the watch list. Those are stocks that I've been diving into the last couple days, and I appreciated what Jan said about Venator materials. Just so happens that that is the one that I found the most opportunity in. And that's the one that Jan pointed out was a spinoff opportunity, and he pointed out how much I enjoy spinoffs. But so he was right. That's one that really caught my eye as having an opportunity, as being mispriced. And as I dug in, I identified what I think could be a catalyst going forward, a unique situation with this company. And so I'm excited to share that with you, and then share some of the basics, and then hear what you all come up with in your own research. So we're talking about Venator Materials, VNTR. The market capitalization is $1.3 billion. So it's in that small cap range. Yeah, that's right, small cap. And the price per share right now is just under $12. That's where it closed yesterday. So it fluctuates around that range. If you look at a chart, it looks like a falling knife. So definitely keep that in mind. Since it's spun off, I think it had a little bit of a ramp right after that, but then it's sold off and has continued downward. And that's fine. But anytime you see that, you should be prepared that may continue. So your entry price, you may want to pay attention to that and pay attention to what the market's doing. And that's something that I can help with, and that I will inside the Patreon group. I will probably enter a position now. I will enter a position now at its current price. But I think for some investors, you may want to wait until there's a little bit of a momentum shift in the other direction before entering, especially when you can identify a stock with 75%, 100% or more upside potential. Then it's okay to miss out a little bit on the front end gains, so that you can wait until you see the technicals moving in a direction that's a little bit more favorable to you. That way you don't have to stay in it as it's continuing to decline, as that falling knife is continuing to fall. So you don't have to try to catch it on its way down. So that's a style thing. It's a preference thing. For me, I'm thinking a little bit long term. I don't anticipate, because of the things that I'm going to outline today, that it will continue down for the next year. I think within a year it'll be trending back up. So I'm okay with a little bit more downside. I think the floor is pretty close, and so that's why I'm okay with that. I hope that makes sense. With all of this, with anything that I share, you have to remember that everyone's a little bit different in their trading styles. I mean, even the most successful investors in the world, you can put them side by side. They're all a little bit different. And so, I want to share with you what I'm doing, but also give you some ideas that might be more comfortable for you and your personality and your trading style. So take what I'm giving you and adapt it and make it work for you. That's my goal. And so, yeah, it may make more sense to you to wait until you find a better entry price, based on, I would pay attention to some technicals there just to get an idea of market sentiment and consumer sentiment. So anyway, VNTR market cap's 1.3 billion, sub $12. It's in the specialty chemicals industry. Specifically, it focuses on two segments. The titanium dioxide is the chemical that they're dealing with, and then they deal in performance additives. So you'll see them supplying companies like Sherwin-Williams. That's probably the biggest name that I recognize. But they're one of the largest players in this segment. There are two others that I'll talk about as far as comps that we can compare to, two others that are fairly similar. But then there's also a Chinese company which makes up about 8% of the market. Venator makes up about 11% of I'm talking about the titanium dioxide market. And then there's the largest competitor makes up 17% of the market. It's Chemours, ticker CC, and then Kronos is the other close competitor here in the other close competitor, and they represent about 8% of the titanium dioxide market. So those are the similar comps, similar size, similar industry, similar diversification makeup as far as the company as a whole. So those are the companies that we'll be looking at when we compare. So I want to talk about some of the problems that Venator has faced, the reason why it's been a falling knife, why it continues to go down. They were a spinoff from I believe it's Huntsman Corporation. They're out of the Netherlands. Sorry, I should know that, but they were spin off last year in August 2017. So it's been about a year, and I've talked about this before. The second year for spinoffs tends to be the best historically, statistically. It is. Spinoffs in general are better over their first 2 or 3 years. The second year is the optimal year. It just takes a while for large investors to get comfortable with a new stock. There's a lot of new information to take in, and it takes a while for everyone to get acclimated with everything that's going on with a new company. So it makes sense that it would take a while to flesh out. But Venator has more problems than just the confusion, the natural confusion around a spinco. They also, right before they spun off, their largest facility, which was actually the largest titanium dioxide facility in the world, it had fire damage, and nobody got hurt, but it was significant damage to the property, and so their capacity was damaged greatly. And like I said, that was right before the spinoff. It was still spun off, so that dramatically hurt its ability to keep up with the production it had been producing before. The same level. So that's a facility in Finland. They have been working to rebuild it because obviously it's very important to the company, but they have run into a lot of issues. The estimates for the costs have continued to go up over the last year, and their insurance payments are less than what the reconstruction costs will be. So that's been a stress on the stock because investors are concerned about how much is ultimately going to cost to get that up and running. And they just received their last insurance payment in the last quarter. So this next quarter, there is an expectation that it will be lower, and it will be because they still don't have the facility up and running. That's not projected until 2019 as it currently stands. And then they won't have that insurance payment to offset what they're losing because it's not up and running. So yeah, it'll be lower, and that may push it down further whenever we hear how low it actually is, whenever Q3 numbers are announced, or it may already be priced in. I don't know. I'm not gonna pontificate about that, but long term, I think as they get things up and running, they are positioned strategically to ultimately outperform their competitors, especially from a stock price perspective. And so to help offset this, another concern, I don't think it's really a problem, but another concern that investors have is they have entered into negotiations for an acquisition of the company Tronox, Tronox. And they make up about another 6% of the titanium dioxide sector of the industry. So like I said, Venator is 11%, and this company is about 6%. So they're working on that acquisition. And there are some concerns about it making it fully through the FCC as the company stands today. They may have to divest a facility in Ohio, just depending on how it plays out in U.S. courts. If they have to do that, then the price adjusts favorably for Venator. But if they get to keep the facility in Ohio, then that will naturally offset some of what they're losing in the Pori facility in Finland. So that's part of their strategy, is to help offset some of their loss that they're missing out on now, so they can take over some of what Tronox is bringing into the market, that supply, and then use all their current facilities and the efficiencies that they have in place to get that into the market and profit from that. So anyway, those are the problems and concerns that they have going on right now. They were a spinoff, so there's natural confusion there. They had the fire in their facility, which added a whole bunch more confusion. And then there's a lot of confusion around when that's going to be done, how much that's going to cost. And then the acquisition, which again adds some confusion because we don't know exactly how it's going to play out. We don't know how it's going to make it through the court system. So if I haven't sold you on this stock already or entirely turned you off, then yeah, I guess we'll see how it goes from here on out. But with all of these stock picks, I'm not looking for the most attractive company. The most attractive company would already have investors in it, and it wouldn't be an opportunity for us. So you have to keep that in mind. What we're looking for is we're generally looking for problems, but we want to know if the market has overreacted to those problems or if their reaction was justified. And I think in this case, their reaction was overdone. And I think over the next couple of years, they will be back up and running back at a normal level. And when we look at the valuations compared to their competitors, I think that opens the door for some opportunities for us here, for us with this play, if you're willing to hold it for the next couple of years. So let's look at the upside. So as a result of all of the things we talked about, their stock has been pretty suppressed. Just on a really basic level, their PE ratio is 3.2, and you can compare that to Chemours, which, remember, the ticker is CC there, and then Kronos, the ticker for Kronos, if you're playing along at home, is KRO. And so the ticker there, KRO, and they have a PE ratio of 7.9 and 8.7, very similar, respectively. That's Chemours and Kronos versus the 3.2 of Venator's. So there's a big difference between these companies. Obviously, I would rather look at the EV/EBITDA for a company like this. This is a pretty capital-intensive industry, so I'll take out the depreciation and amortization right now just for a fair comparison. And when you do that with Venator, you get a 3.36. And then with Chemours, you get 6.49, and Kronos, you get 5.1. So even if you take that low end, the 5.1 EV/EBITDA valuation, and you apply that multiple to Venator, then the price per share would be over $20. So that implies that the exact number is where it is today, and what that number is, that implies a roughly just under a 75% upside. So, and again, that's at the lowest multiple. I think in a couple years, based on what they have going for them, they will be strategically positioned better than Kronos. So I think they deserve a multiple higher than Kronos. So I think there is something more of a closer to 100% upside with this position over the next probably about 2 years for that to play out. Because the market seems to be pricing them for failure, for the most expensive possible cost for the Pori facility rebuild, the worst possible outcome for the acquisition, and so that can play to our favor as if things turn out slightly better than worst possible scenario. Obviously, it is absolutely possible that things could play out terribly, and if that happens, then maybe it's priced appropriately as it stands today. Again, that's why we look at the downside. So the second part of the equation, of course, is the downside. And when you look at the downside, This is a pretty asset-intensive industry. There are facilities that are operational that Venator is using for both of these segments that are attractive to other companies in the industry. So Chemours and Kronos would absolutely be interested in a divestiture from and be able to capitalize on a divestiture from Venator if that were to happen, if they were to sell some of their assets, some of their facilities. So looking at the book value or the intrinsic value of Venator can be valuable in this case for assessing a downside. That's not always the case for all stocks, but this is one here where it's a pretty physical asset intensive industry. And when you look at the price to book value, Venator is less than 1. So they actually have a 0.9 price to book value. So that's good. They're trading below their assets. And then you can compare that to Chemours with a 7.6 and Kronos with 2.8. So Kronos is trading almost, well, I guess more than 3 times what Venator is, and Chemours is trading way over what Venator is. So there is some downside protection there. There's only so much further they can go down. So we're talking about their existing facilities, the valuation as they stand now. We're not factoring in something for the future value of the Pori facility. We're talking about the cash that they have. There's no more insurance payments. This is what they have, and they're being valued at 0.9 of those assets. So that plays to our advantage on the downside as far as downside protection. If there's a market crash, then these other companies should be affected worse than Venator. And if things play out poorly and none of these things, all the worst case scenarios happen, like I said, again, this should help protect us on the downside. And then finally, the last part, the catalyst. The big thing that I see here is when you look at the insider ownership or the major holders, not the insiders. The insiders is important. The original company still holds quite a few shares. The insider ownership is about 50% of the company, which is fine, which is good. So they have a vested interest in its success because they're tied to. I mean, that's a pretty large chunk that they own, that they want to see successful when you're talking about half of this company. But I was more interested in or intrigued by the individual institutions that were in this company. And you can see more and more of them trickling in. But there are several hedge funds, many of which have in the past played activist roles in different companies. You can see David Einhorn's Greenlight Capital is in there. You can see Appaloosa. The specific name is not important, but the point is, there are a lot of firms in there that have resorted to activist roles in the past to kind of make things happen when management isn't doing a good job, but there is opportunity. This is a case where there is opportunity, and my point is that if they see that management isn't doing a good job, or they perceive that they aren't, or they whatever, then you have at least 4 or 5 major holders who own the significant portions of this company who have a history of stepping in and taking an activist role. Now, of course, activist roles they're not a panacea. They don't always play out. But again, you have to pay attention to the company and the opportunity that's there. And for the reasons that I already cited off, I think there is that opportunity there. And so if you have somebody in that role that knows what they're doing, then I think that can be a catalytic event to help boost the shares. I think an announcement that one of them was taking an activist role, that one of them was pushing for board seats or anything like that, just that announcement would be catalytic and cause a gap up in price. I think investors would love to see that. I think they've been slightly concerned with the way management has been treating the stock or treating the company, some of the decisions that they've been making. And so I think if they saw that, that's my my hypothesis. If they saw that, there would be a gap up in price. Of course, if that didn't happen, if one of these guys took an activist role and there was no gap up in price, then perhaps that invalidates my thesis, and maybe that would be a reason to exit. But I don't think that'll be the case. I think that's a big opportunity for the future. Anyway, love to hear what you think. So I think the upside is a conservative 75%. The downside is pretty close to in. I think it absolutely could fall further on momentum, but I think if you get too low, then the price to book value, the assets would quickly pull it back up, as other companies would be interested in the assets, the lucrative assets that they have. And then the catalyst specifically being the fact that there are so many potential activists that have a vested interest in the future of this company. So let me know what you think. I hope that helps. I'm pretty excited about this opportunity and to continue to dive into it. So I'd love to do that with you, and I'll talk to you soon. Take care.